Top-down analysis serves as a fundamental framework for identifying signals from institutional investors, often referred to as smart money. By leveraging this analytical approach, traders can effectively avoid deceptive setups, thereby making more informed trading decisions. This technique significantly enhances a trader's capability to accurately interpret prevailing market trends. In this context, understanding liquidity sweeps is crucial. Recognizing instances when the market ensnares sellers becomes pivotal for traders. This awareness aids in preventing premature entry into trades that contradict the prevailing trend, thereby constituting a critical component of successful trading practices. Moreover, identifying demand and supply zones on higher time frames proves essential in mitigating the risk of making misguided decisions based solely on lower time frame signals. This procedural diligence ensures that trades remain congruent with the overarching market direction, fostering more judicious trading strategies. Transitioning to the crowd technique, a prevalent trading methodology, it often generates confusion due to its dependence on various time frames and the excessive clutter that accumulates on charts. Such clutter can inadvertently lead traders to overlook critical opportunities in the market. Conversely, dynamic top-down analysis streamlines the trading process by utilizing only 2 time frames. This focused approach allows traders to maintain clarity in their charts while adeptly identifying key market levels, effectively filtering out extraneous information. By implementing dynamic top-down analysis, traders gain the ability to precisely identify entry opportunities that are congruent with higher time frame levels. This strategic alignment enhances the potential for successful trading outcomes through a more concentrated approach. Furthermore, amalgamating insights from various time frames empowers traders to effectively discern key support and resistance levels. This methodological alignment ensures that trading actions are consistent with the overall market structure, promoting more robust trading decisions. Identifying crucial levels within market structure necessitates the recognition of extreme swing highs and lows. These pivotal points serve as indicators where substantial price movements have previously taken place, reflecting areas of significant market interest. The discussion within the video underscores the importance of price levels that have historically functioned as both support and resistance. Such levels are integral as they indicate robust market interest, thereby outlining critical areas for trading consideration. Demand zones, in particular, signify areas where institutional investors are likely to initiate trades. Recognizing these zones holds the potential to considerably enhance trading outcomes, as it informs decision-making processes regarding entry points. Additionally, liquidity sweeps frequently ensnare sellers, consequently generating favorable opportunities for astute traders. A comprehensive understanding of this concept enables improved identification of advantageous entry points, maximizing profit potential. Lastly, conducting analysis on higher time frames bolsters the validation of trading setups while effectively managing associated risks. Aligning trades with broader market trends significantly elevates the probability of achieving successful trading outcomes.